Global economic data has generally continued to improve through August and early September. The Eurozone exited recession for the first time in 6 quarters as second quarter GDP rose 0.3% quarter-on-quarter. Purchasing Managers' Index readings, a commonly watched leading indicator of growth, strengthened again, reaching 2-year highs in Europe, with the improvement spreading beyond the core as manufacturing indicators also moved back into expansionary territory in peripheral countries. In the UK, manufacturing PMI reached a 2.5-year high, with services PMI reaching a 6-year high. US second quarter GDP was revised higher to 2.5%, while service and manufacturing leading indicators rose to 7- and 2-year highs respectively. There was some disappointment with recent housing data, as US mortgage rates have risen, but affordability levels remain high by historic standards, which should underpin the market. Japanese second quarter GDP was revised higher to 3.8%, while Chinese data also began to stabilise, having lost momentum in recent months, as exports and industrial production improved for the first time since the beginning of 2013, and manufacturing indicators moved to 16-month highs. Overall, the positive momentum in the global economy looks set to continue in coming months, with global growth probably reaching between 3 and 3.5% in 2014. While equity markets are close to year-to-date highs and have rebounded from weakness related to tensions in Syria, there has been an increasing divergence between equity and bond markets in recent months as bonds have continued to fall. As can be seen in the chart, yields have risen in core global bond markets since May and are at 2-year highs due to the improving global economy, reducing the requirement to hold safe haven assets as investors become more confident about the increased levels of financial stability and the growth outlook. Expectations of a reduction in bond purchases by the US Fed as it begins to taper QE3 have also pushed US yields higher, which in turn has pulled up yields in other global markets. In the short term, bonds could get some relief from the removal of speculation and uncertainty relating to the timing and size of any tapering of QE3, with the market expecting the Fed to announce details of its tapering plans in mid-September. Thereafter, however, ongoing improvement in the growth outlook is likely to continue to cause core global bond yields to drift higher, with US yields probably seeing greater upward pressure as changes in the Fed leadership and committee membership reduce the level of transparency around monetary policy in 2014. Equity markets remain attractive on a valuation basis, both in absolute terms and relative to other asset classes. This chart shows one of the most commonly used valuation metrics for equities, the price-to-earnings ratio, for world equities going back to 1988, and shows the current PE of 13.9 times is still below the long-term median of 15.5. There have been some concerns that rising bond yields referred to earlier could pose a threat to equity markets. This chart shows monthly plots of the US equity market PE against bond yields, and if anything, the slope of the line is upwards, highlighting that equity valuations can in fact rise as bond yields move higher. The reason for this is that if bond yields are rising because the growth outlook is improving, then the fundamentals for equities are also improving in terms of a better economic and earnings backdrop, which is supportive of equity markets. With global economic momentum set to improve further, equity markets can continue to move higher, even as bond yields continue to rise and QE3 tapering begins. With equity inflows outweighing those into bonds and fundamentals and valuations remaining supportive, equity markets can continue to move higher.